So this video is going to determine how stupid Scott Horne can be versus ChatGPT in relation to owner financing. I've always wanted to be humiliated by a computer. We're going to see how it goes. So guys, if you like this video, take a minute and like us. Don't forget to comment below, and don't forget to subscribe to our YouTube channel. Now, in addition, if you comment to these videos, there is going to be a drawing to get to spend somewhere between 30 minutes and an hour with me on the phone talking about either your transaction, the owner finance industry, the business, whether it's buying or selling, whatever it is you want to discuss regarding the residential real estate investment industry. So don't forget to comment, and we're going to announce the winner of that in about 2 weeks online. So this first one, I asked ChatGPT just to explain basic owner financing, and of course it's registered here on the screen. So again, it comes out in a very generic base, just talking about a particular type of owner financing. It doesn't mention anything about existing debt, no debt, who the seller might be, a homeowner versus an investor, or items of that nature. So as I look at this overall, I'm seeing the agreement in terms, which is reasonable. It's just generic in nature. It talks about just a basic promissory note. Here in Texas, we call those a real estate lien note. It talks about the mortgage or deed of trust, which is good. The down payment, repayment terms, items of this nature. But it just gives you a basic overview. It doesn't talk about the nitty-gritty that we have to know in our industry in how to structure a transaction. I do see one glaring issue here where it says that the seller retains title to the property until the buyer completes all payments according to the terms of the promissory note. So that is absolutely incorrect. That would be an executory contract. Here in Texas, we'd call that a contract for deed. Other states would call that a land contract in some format. But when we're doing seller financing, whether it is a direct seller finance from a seller who has no debt, a wraparound mortgage, whether we're buying or selling the property, or a subject to transaction, again, buying or selling, title is always transferred. So remember that, guys. If you don't transfer title, anything can happen. In fact, I was on a call today where a person had bought a property, supposedly closed this in a title company, but the deed never either got executed or recorded. And one, he thought he owned the property. And what happened a year later is that the seller, thinking they still owned the property, did a loan modification that, of course, affected everything. Now we're having to go back, fix issues, and cure problems along the way. It does talk about owner financing being beneficial for the parties out there and that there are risks involved. It just doesn't get into what those risks are. Now, maybe if I ask it something more specific, it will tell us that. So I'm just going to ask it basically, what are the risks of seller financing? Now, as I'm reading, as this is coming up, it talks about the buyer default is the biggest risk. And of course, I disagree with that. I think the biggest risk, especially if there's an existing mortgage on the property, is due on sale. I think the second biggest risk for investors is if your borrower was to file bankruptcy along the way. You know, it talks about property condition. I get that. And is there a risk that you sell a fully renovated home to a buyer and that buyer destroys the house because it's their home? Unlike a tenancy where they can be charged for that, a homeowner doesn't get charged for that. I've seen situations where a borrower does go into default And while they're going through the foreclosure process, the bankruptcy process, whatever it might be, this delay process, they are stripping the house. I've actually seen houses stripped of everything from the ceiling fans, the doorknobs, the appliances, the countertops in the kitchen, bathrooms, the cabinets themselves, commodes, anything that might have some potential future value, I've seen stripped. They take the doors, even the baseboards sometimes. I've seen the carpeting rolled up and taken out, and you go, all the effort to do that is crazy, because unless you have the ability to reuse it, it's not worth that much to somebody else versus the time it takes to do it. So it's just really a mentality of destruction and vengeance oftentimes, rather than trying to make money in some format. It talks about an opportunity cost of tying up money. Now, I don't agree with that, because I think seller financing is an awesome opportunity. Yes, it does tie up money, but you can borrow that money from a lender, whether it's institutional, mortgage, or private along the way. So you may have some capital in the deal, but not that much. And every deal is a little bit different in how you navigate that. It doesn't mention the fact that you get a down payment from the buyer to help offset those dollars that you may have tied up in the property as well. It talks about a long-term engagement. I get that, because oftentimes you might tie this up with a 15, 20, 30-year type amortization period for the transaction. What it fails to think about, though, is exit strategies for that mortgage, such as the ability to sell the mortgage. And without having to ask 87 questions of it, these are the things that you'd like to kind of see brought up a little bit along the way as you're comparing notes. Are there tax implications? Well, sure there are, but what are they? Really, it simply is treating the down payment sometimes as either long-term capital gains or ordinary income. And then the interest differential that is being received between the buyer and any interest being paid to a lender is a profit that you're going to pay ordinary income on along the way. It talks about liquidity risks. And as I'm talking to y'all, I'm sitting here reading this at the same time, where it talks about seller financing makes the seller's capital less liquid because the money is tied up. And I think we just addressed that one of the neat exit strategies of seller financing is when that transaction is properly originated, utilizing a residential mortgage loan originator to process the buyer, who approves that buyer properly and correctly, there is always the ability to sell that mortgage and to cash out. And based upon the time frame that loan is in place, the credit of the borrower, the pay history, and things of that nature is a direct result upon the amount of money that a future note buyer may pay you for that mortgage. It talks about interest rate risk, and again, I'm reading this at the same time you guys are. If the interest rate agreed upon in the owner financing agreement is lower than the market rate in the future, the seller may end up with a lower return on investment. And guys, that can be true of anything. And I always tell people that in this industry, my crystal ball is either broken or in the pawn shop or something, because it is impossible to try to make decisions based on future events. There's an old saying that you make your money when you buy the property. And sure, you have the option to rent the home versus retail it and sell it for cash, which if you do that, you have to recoup your capital and go do it again. If you rent the home, the question is are you debt-free? What's your positive cash flow? And it sort of is the same scenario with a seller finance when you're looking at these scenarios. And that is with an owner finance, though, the difference is we get a down payment. We're usually selling our home for 110% of market value. We're usually getting 110%, sometimes a fuzz more, of market rents as well. And so we're able to capitalize on some items that are more positive. I will also tell you that I like the selling of a home to a seller finance buyer who puts down a reasonable down payment, because they tend to take better care of your home versus trashing out like a tenant can do. Now, if someone pays you a low down payment, you know, that's kind of like a glorified rental agreement to an extent. So getting a large down payment, people don't want to trash out the house they live in. Does it happen sometimes? Absolutely, like anything else does. Does it happen often? Absolutely not. In fact, what is so rewarding about this industry is watching that homeowner who got a chance to buy a home. They buy a home that's already in really good condition, and then they make it even better, and they make it their home. And that is what is so awesome to watch and see along the way. And it is rewarding from a personal perspective and helping people, you know, transact items like that, which they thought they could never do along the way. And of course it says due diligence, you know, talk with legal and financial advisors along the way. And I get that. But when you look at the three options of the residential investment business, which is a fix and flip modeling, you could probably put wholesaling in there too if you wanted to, a rental model versus a seller finance model. One of the things that I have perceived over the last eons of time that I have been doing this business is that the fix and flip method is a one and done strategy, just like wholesaling is. You got to get back on the hamster wheel all over again. The rental property scenario is awesome, but you have to deal with tenants, toilets, and trash, and as they say, oh my. Whereas with the seller finance modeling, you don't have that same scenario. With the tenant modeling, the average tenant stays in a property anywhere from 18 to 24 months. And when they vacate, you have downtime, repairs to make, and things of that nature. And of course, if a commode leaks, a faucet drips, if a door doesn't close properly, the roof has an issue, the AC has an issue, the landlord gets the privilege of fixing that, whereas on a seller finance modeling, you don't have any of that. And of course, an argument is always made when you're looking at rental property versus owner finance property that you own the rental property, you get to depreciate the rental property, and you own an asset that eventually becomes debt-free if you bought it with financing. And I get all that. The issue I have with depreciation is you have to recapture depreciation. Death and taxes, something we all have to handle along the way. With the seller finance modeling, if you look at a rental property versus seller financing, dollar for dollar, I believe you can buy 1.5 owner finance properties versus the rental property using the same amount of money available, because when you sell that house with seller financing, you're getting a down payment back to recoup the funds that you had to utilize to buy that home, to renovate it, whatever it might be along the way. The difference is that most of the time the seller finance deal doesn't default, that they make the repairs. There's no downtime. And so over the course of a time span, call it 20 years, 30 years, where with the rental property you have repairs, maintenance, issues, vacancy, having to re-let the property, various issues, management, maintaining a thing along the way. With the seller finance property, you don't have that. And so if you add up all of these differences along the way, the 110% income received from the sale of the property, the 110% monthly payment from the sale of the property versus the rental property, and things of that nature, I think they wind up being pretty close to apples along the way. And if that's the case, you have to ask yourself which one is the path of least resistance out there. So let's take another moment and let's ask ChatGPT another question. So guys, this next question is, I just asked it, what is a subject to transaction? Now, the basic response came up is actually reasonably decent and accurate along the way, so I can't really argue with that a whole lot. Where it talks about the buyer purchases the property and gets a deed while the mortgage stays in the seller's name. Now, right there, it doesn't talk about giving the seller back a deed of trust for their protection, which I think is a major issue that needs to be addressed whenever doing a subject to transaction. It also talks about payments, where it talks about the payments can be made directly to the existing mortgage company, which it can be done. But it doesn't talk about the utilization of using a loan servicer for the protection of both the buyer and seller. Now, I get it that on a subject to transaction, the buyer can pay the lender direct because the seller has the ability to verify payments fairly easily by phone, online, and basic mechanisms of those scenarios. But there's also a time and place that it should be mentioning items like the utilization of a loan servicer as well. Now, it talks about no official transfer, but really what they're getting at on that one provision is it's talking about the existing mortgage staying in the seller's name as opposed to the deed transfer of the property over. And it does talk about basic risks to the seller along the way. And those risks are the same as we talked about with owner financing. The buyer can still default. And so long as the seller is protected, they can take that house back through a foreclosure. And so as I go through and I look at how it responds, it gives you, in this scenario, I think, a generalized basic understanding of it without getting down into the dirt of creative finance and subject to transactions, which are really things that you have to know to become proficient at the subject to industry. It does talk about the advantages for the buyer, which I think are obvious in that instance out there. And so far, in my short little 2 or 3 questions I've asked ChatGPT so far, what I'm seeing with all this is it hits on generic basics. And it's just lacking. What I'm seeing is the detail that we need to see. So maybe I can dig down a little bit deeper and find some questions and see if what it does on some detailed questions that are out there along the way. So let's give that a shot. So guys, on this post I ask, why is a deed of trust provided to a seller not mentioned on a subject to transaction? And it completely glossed over what my response is that I'm looking for, which is, of course, for the seller's protection. And it just goes back to the underlying deed of trust. So maybe I can rearrange that question a little bit to get a more specific answer. So right off the bat, it says that in a subject to transaction, it's not, let me make the key word, not standard policy for the buyer to provide a new deed of trust to the seller because the original mortgage and its associated deed of trust remain in the seller's name. So just real quick, when I see that, at least in my opinion, I think that is wrong, because one of the primary goals is to always protect the seller. And the only way to protect the seller is through the utilization of a deed of trust or a security instrument. Otherwise, if the buyer of that property, subject to the existing debt, falls into financial straits or has a hard time or issues, or whatever it might be, and can no longer make payments, the only way for that seller to regain their property is to file a lawsuit, which is expensive, timely, and so often I see in those scenarios, the property goes into foreclosure and the property is foreclosed upon, which becomes devastating to the seller's credit. So as I look at this a little bit, I think it failed in that scenario along the way. So guys, I ask it, what are the 3 types of owner financing? And it comes out back with an all-inclusive mortgage or deed of trust, a land contract or a contract for deed, and a lease option. And of course, to me, those are not types of owner financing. Owner financing is a direct seller finance from a seller who has no debt on the property. It is buying the property with a wraparound mortgage and or buying the property subject to the existing debt. A lease option is an option agreement. It's not an owner-financed transaction. A contract for deed is an executory contract similar to an option. It's not owner financing out there. So again, as I look at ChatGPT answering the questions, I think this would be a little confusing to the novice person looking at that initially in those scenarios out there. I'd have to think about the particular category for the rental and executory contracts on how it got there. But it just wasn't responding to the question, right? Maybe the question simply isn't narrow enough or items of that nature along the way. So let's see what else we can delve into about owner financing with ChatGPT. So I asked ChatGPT, now what are a seller's options if a buyer defaults with owner financing? And it comes back with a forbearance agreement. Okay, so maybe in the banking world that's an option for a seller if they really want to go that way, or modifying the terms of the loan. And I get that because even we in our offices do that occasionally. Now, it talks about demanding full payment, but of course, if there's a default, obviously you want to demand full payment, which if they don't pay, it is accurate, it says you can foreclose, or it talks about a deed in lieu of foreclosure, which again is a viable issue along the way. It doesn't mention items with a deed in lieu of foreclosure that you should take a moment and check title along the way to make sure it's clear before you take a deed in lieu of foreclosure. It doesn't talk about maybe asking the borrower to reimburse you their arrears in a promissory note over a certain time span of some type. And then it talks about evictions. I have no idea where that comes from regarding a default arrangement. It looks like it's talking about a lease purchase, which in my opinion is not a seller finance scenario. Then it comes in and talking about selling the note. So of course, if you're selling a defaulted note, you are going to get hammered in the secondary marketplace when you sell that. Obviously, you'd want to get the house back, resell it, reload the transaction, get a performing loan, and then sell it to maximize your profit along the way. And it does talk about legal action, which would of course be filing a lawsuit, because you can file a suit on the note versus foreclosing on a property and try to recover a money judgment. The problem with that is you have to collect the judgment. This is one of the issues a lot of investors fall short on, where it's easy to win the battle of winning a lawsuit, but it's hard to win the war of collecting the damages recovered in that lawsuit. So it gives you, again, basic generic responses. It just doesn't delve deep enough into it. And again, maybe this is one of those items where you have to really hone in your questions to get more legitimate answers. But so far as I've been asking it questions, it's hitting a peripheral of the question without being able to hone into it fast enough. So in other words, you have to really ask it highly specific questions to try to get specific answers. But even then, I'm seeing some generic scenarios coming out versus direct legal issues that I'm looking to get out of this thing as I'm asking questions to it right now. So I asked ChatGPT about the utilization of a RMLO, a residential mortgage loan originator, when selling a home to a buyer with owner financing. And it comes back with compliance with federal and state laws, but it only talks about Dodd-Frank, which is part of that to a certain regard, which is the ability to repay rule. So in that regard, it was good. But it really left out the SAFE Act, which is where all of that emanates from. So it kind of missed the boat on that. It gives you a part of it, but not all of it along the way. It talks about professional loan assessment. Well, in the owner finance world, a 𝐴𝐺 is not there to assess a buyer's financial ability to repay the loan. Their job is to simply gather information and provide it back to the seller, who is the lender, and the seller lender is the one who has to assess the borrower situation in making a decision. So it tends, it looks like, to go more towards the mortgage world, where the RMLO may be in-house with a mortgage lender. But even in that instance, an underwriter, which is who a seller lender is in the seller finance world, is the party who makes those scenarios. Now, it does mention proper documentation, which is good. It just doesn't stipulate what that proper documentation is, such as the 36 𝐟𝐵𝐷 disclosures. It brings up setting appropriate interest rates and terms. And again, the RMLO does not do that. That is done by the seller or the lender direct in their transaction. It talks about protecting both parties' interests. I don't see how an RMLO protects anybody's interest in a transaction other than providing information to the seller or lender to make an informed decision that might be best for them. Now, I do like the fact that they mention enhancing buyer confidence, because using a RMLO in a transaction tends to make the transaction feel more customary and ordinary, so that a buyer feels more comfortable in the transaction along the way. And I really don't see how they streamline the process. In fact, I call the RMLO today the necessary evil, because we didn't used to have to use RMLOs in the industry. Even though we would still process and underwrite the buyer on our own way, we didn't have all these rules and regulations you'd have to follow and be stipulated to in the creative finance world. And actually, to me, it kind of bogs down the industry a little bit. It's not that they're a bad thing to utilize in the industry, because it does tend to get rid of some of the lowlifes who are trying to play this game, because it makes you comply with some rules and regulations, so I like that part. But I don't see it being a streamlining process along the way. So again, I don't see a lot of in-depth issues here with the RMLO per se, and it is possible I could ask some more questions to dig down deeper, but I don't know if it's going to give me the answers I want to see and understand involving the seller finance industry. So guys, I hope you found this a little bit helpful. Just looking at nuances between ChatGPT and myself as I think through the questions and what ChatGPT says about seller financing and various things. This is just the first of many videos we're going to do regarding this. I think it's going to be very interesting to see what it comes up with and how we can compare and contrast the two for the open marketplace out there. So if you found this video helpful, guys, don't forget to take a minute and like the video. Don't forget to subscribe to our YouTube channel too. If you got any comments, take a minute and comment below for us. And if you have questions or comments about other things you'd like to compare and contrast with ChatGPT, let us know. We'll be happy to do our best to do that for you. And lastly, don't forget to take a minute and make some comments so we can put you into the pool for that free 30-minute to hour conversation with me regarding your transaction, your questions about owner financing, or anything in the real estate investment industry. We'll see you guys next time.